Hello, my friends. In this video, we're going to be talking about boosting your borrowing capacity. I'm going to try and make it a not very boring topic. So I'm going to try and keep it exciting, quick, and fast-paced. So make sure you drop a like on this video, subscribe to the channel down below, and let's dive straight into how you can boost your borrowing capacity so you can go forward with that next investment property purchase, grow your property portfolio, and grow your passive income to create more choices in your life and to set yourself up for a retirement. Now, the key one here that it's really hard to get around when it comes to serviceability is to actually boost your day job income. Boosting your day job income is going to make a massive difference in terms of the bank's calculators when they look at you for servicing debt. You don't have to stick on this higher PAYG or self-employed income forever, but if you can show 2 years of steady employment history and show a growing income, and you can hold that higher income for a period of time, say you're able to get a promotion for 1 or 2 years at a higher rate, $120,000, $150,000 if you're in that situation, if you're an engineer or an accountant or an IT consultant. If you're able to hold that higher level of income, you'll be able to get access to more debt and to grow your asset base. After you've acquired the assets, you don't necessarily have to have that high paying job anymore. And you can go into a role like working at a fish and chip shop, working at the movies, working at a gas station, whatever you really love, or doing something that you enjoy. I know those are lower income opportunities, but maybe you work 3 days a week and spend time doing things you love. Move into those passion projects once you've acquired the assets in your portfolio that you need. Step number 2 is to continue growing your deposit. Obviously, a larger deposit is going to be able to allow you to access a larger purchase price, and every $10,000 you save typically gives you a 5x return in terms of the capital you're able to acquire. So obviously, if you save $100,000, you can typically get a 20% deposit down for a $500,000 asset. But if you saved $200,000, you might be able to use that as a deposit towards $1 million asset. So every $10,000 you save is going to give you a 5x return on your money in terms of borrowing capacity. Step number 3 is if you're in the situation, you might want to pay down debts. Now, this is not something that I would use personally in a growing phase or in an accumulation phase of a property portfolio. But for some, paying down debts is part of their risk profile. They'd rather not use the offset account and rather pay down the debt directly. And if you do that, when you go back to the bank, you'll be able to lend more money. For me, I'd rather use a 100% offset account and park my cash in that account to go and use for future deposits rather than pay down the debt in the short term, but it's definitely an option you might want to explore. The next one for me is to remove bad debts, in particular credit cards and car loans. These types of debts can have a multiple of anywhere between 5 to 8 times in reducing your borrowing capacity. So like we said earlier, the deposit's going to give you roughly a 5x in increasing. Credit cards and bad debts are going to reduce your borrowing capacity by a similar amount. So if you had a credit card limit of say $10,000, the bank might reduce your borrowing capacity by $40,000 or $50,000 depending on the situation. Of course, banks have different policies, but this is a rough overview. And so if you can cancel the credit card before you go for the loan application with the bank, or you can make an agreement with your broker that you're going to cancel the credit card to increase your borrowing capacity, that might be a lever or an option you can pull in growing your property portfolio and allowing you to access more leverage. The next one on my list is to assess your living expenses. The banks use something called a HEM, which is an estimate of your living expenses, or they'll look at your actual living expenses if they're slightly higher than the HEM. So they're either going to use that baseline HEM model, or they're going to look at your actual living expenses and assess you on that situation. Now, again, it's different between different banks, but if you can minimize your living expenses for the 3 to 6 months leading up towards getting a loan, then you're potentially going to be able to access more cash to buy an investment opportunity and put your money to work. Whereas if you have $7,000, $8,000, $10,000 a month of living expenses rather than $4,000 or $5,000, that could significantly reduce your borrowing capacity when you go to the lender and show them your financials. So for that short period leading up to the loan, try and reduce your living expenses. Now, the last one I want to talk about is your financial health, and that really is your credit score. If you have a black credit history or a marked credit history, it's going to make it a lot more difficult to get loans with large and mid-tier lenders in the right situation. So the way to try and improve your credit history is to make sure you pay all of your bills and all of your expenses and credit cards on time, so you're not paying any interest, to remove any other bad debts you might have, and to make sure that you're building your credit over time. This is achieved by ensuring you pay all all of those debts as and when they fall due. And that's going to boost your score up towards the 700s, 800s is ideal for a squeaky clean credit score. This will allow you to access lower interest rates with banks and lending institutions and put yourself in the best possible position when a lending specialist assesses your credit rating. Now, to close this video out, I wanted to have a talk about lender's mortgage insurance and how you might be able to find that sweet spot or that balance between using lender's mortgage insurance to preserve your cash and also not giving too much money in fees to the bank. Now, the sweet spot historically has been around that 12 to 13% mark in terms of lender's mortgage insurance. What Emily and I have actually done is, yes, in our first property, we did use a lower deposit, but for the future properties, we pulled out equity and used our equity to create a 20% deposit for our next purchases. That enabled us to avoid paying $10,000 or $15,000 for lender's mortgage insurance, and we could use that money to go towards renovations. But if you're in a situation where you've got a low deposit and a reasonable income, then using lender's mortgage insurance at say a 13 or 15% mark might be the right option for you. So you don't reduce your cash reserves. You want to keep a decent cash buffer in place. You don't want to go out and get a loan and have $5,000 in the bank. Ideally, you want to have a few months or at least 6 months of living expenses, $25,000, $35,000, $50,000, depending on your situation. So what this means is lender's mortgage insurance might be a great option for some, but for others, you might be able to get away and do the 20% deposit to avoid paying LMI. At the end of the day, inflation is going to continue to eat away at your cash. If you had $100,000 in the year 2000, that would have devalued over time as the cost of goods and services has increased over the last 22 years. So parking cash in the bank is not going to be the best solution over the long term. Now, depending on your risk profile, you may want to work out how much or how little you decide to leverage and buy investment properties. That decision is up to you at the end of the day. It's your money, so you need to put in the hard work and make that choice to make the money work hard for you. If you're looking for a Brisbane-based buyer's agent, then head over to purposeproperty.com.au. We can book in and have a free strategy session with myself. We'll have a chat about your situation, your short and long-term goals, and how we can potentially help you buy a property in the Brisbane market. Otherwise, make sure you drop a like on this video, subscribe to the channel down below, and click this video over here for more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.